Hello everyone, welcome back to the Intelligent Investor channel. In this video, I'm going to talk about Meta stock versus Alphabet stock to see which company is better to invest in over the long run. Specifically, I'm going to analyze Meta stock to see whether Meta is really turning around now, especially after Meta stock had the worst performance in 2022. For example, if you look at this here, you can see Meta did underperform the S&P 500 by a fairly large margin over the past 5 years. Of course, past return does not guarantee future results, but I want to show you this here first before talking about whether Meta is really turning around. At one point, near the peak in August 2021, Meta was over 1 trillion in market cap. Then Meta tanked as much as 78% between the peak in 2021 and the bottom in 2022. At the time of making this video, Meta has recovered a lot and it has a market cap of 613 billion. If you time the market right and bought Meta stock near the bottom, you will have made as much as 170% in capital gain. If you're interested in investing in Meta, I think there are two important questions here. First, is Meta's advertising business turning around even though its revenue growth has slowed down a lot compared to before, where Meta used to have double-digit revenue growth? And second, will Meta continue to recover going forward? I'm going to answer these two questions in this video by talking about these topics. My major mistake investing in Meta stock, Meta's earnings and financials review, Meta's long-term strategy, Meta versus Alphabet, which stock is better over the long run, Meta stock valuation, and will I buy Meta stock? If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock analysis and investing videos a week that will help you become a great investor. Each video usually takes me 20 to 30 hours to make, so if you like this channel and want to support it, check out my Patreon blog in the video description. Our goal is to help all our members grow their stock portfolios to over 7 figures over time. Once you become a Patreon member, you can follow all the stocks I'm investing in for the long term and download the latest intrinsic value calculators for all the stocks I'm analyzing, so you will know when a stock becomes undervalued, fairly valued, or overvalued now. Also, you will have access to all my latest stock ratings for all the stocks I'm analyzing. The link is in the video description. Take a look, let's start. So what was my major mistake investing in Meta before? I'll share with you my mistake here, so hopefully you can learn from my mistake and won't repeat the same mistake as I did before. Full disclosure, I invested in Meta for several years before I sold the stock. At one point, I was making large gains in Meta before Meta tanked as much as 78% between the peak in 2021 and the bottom in 2022. I made the mistake of selling my Meta shares near the bottom here because I thought Meta was becoming a value trap. Also, I was afraid that the stock would drop further. Obviously, looking at this in hindsight is always more clear. There are several major reasons I decided to sell my Meta shares. The first reason is that Apple's app tracking option has affected Meta's app business a lot. If you download any iOS apps on your iPhone or your iPad, you will need to consent to allow the app to track your activities across other companies' apps and websites. Obviously, most people will opt out of this app tracking option. Because of privacy reasons, most people do not want advertisers to track their activities across other websites and apps. Meta or Facebook relies on a lot of personal data they collect in order to give you more relevant ads and to allow advertisers to measure their ad performance. In theory, this means Meta or Facebook can no longer track you using your iPhone's unique ID for advertisers, known as the Identifier for Advertisers, or IDFA. This makes ad targeting and ad performance much harder to measure for Meta. The second reason I decided to sell is that Meta is facing a lot of competition from TikTok. TikTok is the most popular short-form video platform compared to Reels, and TikTok has been growing at a much faster rate than Meta. Initially, I thought TikTok is likely taking a lot of online ad market share from Meta. The third reason is that Mark Zuckerberg decided to rename Facebook to Meta. More importantly, Mark Zuckerberg decided that Meta will focus on investing in the metaverse business or reality labs for the long term. Mark Zuckerberg wants to build the next mobile computing platform called the Meta Quest headset to replace the iPhone. So Meta's most important social media business will no longer depend on Apple's iOS ecosystem or Google's Android ecosystem. I decided to sell Meta because I did not like the fact that Meta has been losing a lot of money in the metaverse business every quarter, even more than Alphabet's other bets almost every quarter. For example, if we compare Meta's reality labs to Alphabet's other bets every quarter, you can see Meta has been losing a lot more money in the metaverse business compared to Alphabet's other bets every quarter, even though Meta earns less profit and less revenue than Alphabet. Another reason I decided to sell Meta is that Apple is expected to release its mixed reality headset very likely this year, which will compete with Meta's reality labs business. Apple has a history of introducing new product categories and becoming the leader in almost every new product category. For example, Apple's iPhone, iPad, Apple Watch, and Macs with Apple silicon chips are leaders in their product categories. Personally, I think Apple has a better chance of making the mixed reality headset or the AR glasses the next mobile computing platform. Looking back in hindsight, I was likely wrong about Meta. I thought Meta was becoming a value trap. I thought Mark Zuckerberg mismanaged Meta because Zuckerberg changed Facebook's focus from a social media company to a metaverse company. Of course, the metaverse business will take many years to become profitable. Meta has recovered a lot since I sold the stock. In hindsight, I should have held Meta stock and let it recover over time. What surprised me a lot is that Meta's advertising business is much more resilient and stronger than I first thought, even though many advertisers have slowed down their advertising spending. At the time of making this video, Meta's ad business is recovering even though it's still impacted by Apple's app tracking option and even though it's still facing a lot of competition from TikTok. For example, Meta has been using AI tools and on-site conversions such as click-to-messaging ads to improve ad targeting and ad performance for advertisers with much fewer user data than before. Meta's recent quarterly sales increased compared to last year. Meta was able to beat analyst earnings forecasts in almost every category. According to the Wall Street Journal, the quarter also included a surprising return to growth for advertising revenue, which rose 4% year-over-year to $28.1 billion. The company also added 37 million daily active users, nearly 3 times the additions expected by analysts. Meta also projected total revenue for the second quarter in a range of $29.5 billion to $32 billion, the midpoint of which is nearly 5% ahead of what analysts had forecast for the period. Meta stock, which has already surged 74% since the start of the year, jumped another 12% following the results. Here's another sign that shows Meta is likely turning around. If you look at Meta's operating margin here, you can see Meta's operating margin was in a downward trend for many quarters. In the most recent Q1 quarter here, Meta's operating margin grew quarter over quarter. This is because Meta has been laying off many employees, around 20% of employees in recent months, laying off many middle managers in order to make the company more efficient, cutting office spaces, and reducing investments in many projects that are not essential. Mark Zuckerberg calls 2023 the year of efficiency. Going forward, I think Meta's operating margin will continue to improve because Meta is much more focused on cost efficiency and not overhiring employees like before. Here's another reason that will likely benefit Meta's ad business going forward. I said this in one of my Meta stock analysis videos before. Many US regulators want to ban TikTok in the US because of national security reasons. Of course, I do not know whether this will happen. Many advertisers may shift their ad budgets from TikTok to Meta and Alphabet going forward because of the political tensions between the US and China. Obviously, restricting or banning TikTok in the US will benefit Meta's ad business the most. I want to show you Meta's latest financials here. I think these financials and performance data show that Meta is likely turning around. For example, in the most recent quarter here, Meta's family daily active people grew to 3.02 billion. This is a huge competitive advantage for Meta because Meta has a lot of personal data on each person who uses Facebook, Instagram, Messenger, or WhatsApp every day. Meta knows what each user likes or dislikes. Meta knows what each user likes to watch. In my opinion, I believe this propriety of first-party data is Meta's biggest competitive advantage because it allows Meta to give more relevant content and ads to users. Also, Meta's first-party user data helps advertisers target more relevant ads to users and helps advertisers measure their ad performance without using too much third-party data collected from other apps and websites. I think this is why Meta's ad business is recovering and it's not impacted too much by Apple's app tracking option. Meta's average revenue per person was $7.59 in this quarter here. I think Meta's average revenue per person will improve over time once the overall advertising market starts recovering in the upcoming months. Facebook's daily active users grew to slightly over 2 billion in this quarter here. Going forward, I think the most user growth should be coming from Instagram because Instagram is much more popular among younger users. Facebook is very mature and it's more popular among older users, so I think Facebook's user growth rates will continue to be very low going forward. In terms of revenue and operating income, Meta still earns nearly 99% of its total revenue from Facebook, Instagram, WhatsApp, and Messenger. Advertising still makes up around 98% of Meta's total revenue. Family of apps business contributes 100% of Meta's operating income. Reality Labs still loses a lot of money every quarter. I think the most important thing here is that Meta's operating margin improved in this quarter here. I think Meta's operating margin will continue to improve going forward because Meta is much more focused on cutting costs, improving cost efficiency, laying off employees and middle managers to make the company more efficient than before, especially since Meta offered high employees during the pandemic, reducing office spaces and getting rid of projects that are not important right now. In my opinion, Meta has a very strong balance sheet. For example, in the most recent quarter here, you can see that Meta had $37.44 billion of cash and marketable securities. In comparison, Meta had $27.58 billion of debts and operating lease liabilities. This means Meta can pay off all its debts and still have a lot of cash left. I want to share with you the most important parts of Meta's earnings call here. It shows Meta's long-term strategy and long-term prospects in generative AI, monetizing Reels short-form videos, and the metaverse business. Mark Zuckerberg and his management said this in a recent earnings call. Reels continues to grow quickly on both Facebook and Instagram. Reels also continue to become more social with people resharing Reels more than 2 billion times every day, doubling over the last 6 months. Reels are also increasing over app engagement, and we believe that we're getting share in short-form video too. A key theme I want to discuss today is AI. I've emphasized for a number of these calls now that there are two major technological waves driving our roadmap, a huge AI wave today and a building metaverse wave for the future. Our AI work comes in two main areas. First, the massive recommendations and ranking infrastructure that powers all of our main products, from feeds to Reels, to our ad system, to our integrity system, and that we have been working on for many years. And second, the new generative foundation models that are enabling entirely new classes of products and experiences. Our investment in recommendations and ranking systems has driven a lot of the results that we're seeing today across our discovery engine, Reels, and ads. Along with surfacing content from friends and family, now more than 20% of content in your Facebook and Instagram feeds are recommended by AI from people, groups, or accounts that you don't follow. Across all of Instagram, that's about 40% of the content that you see. Since we launched Reels, AI recommendations have driven a more than 24% increase in time spent on Instagram. Our AI work is also improving monetization. Reels monetization efficiency is up over 30% on Instagram and over 40% on Facebook quarter over quarter. I think there's an opportunity to introduce AI agents to billions of people in ways that will be useful and meaningful. We're exploring chat experiences in WhatsApp and Messenger, visual creation tools for posts in Facebook and Instagram and ads, and over time video and multimodal experiences as well. I expect that these tools will be valuable for everyone from regular people to creators to businesses. For example, I expect that a lot of interest in AI agents for business messaging and customer support will come once we nail that experience. Over time, this will extend to our work on the metaverse too, where people will much more easily be able to create avatars, objects, worlds, and code to tie all them together. Finally, let's talk about AI infrastructure and the CapEx. This has been a major investment for us. A couple of years ago, I asked our infra team to put together ambitious plans to build out enough capacity to support not only our existing products, but also enough buffer capacity for major new products as well. And this has been the main driver of our increased CapEx spending over the past couple of years. At this point, we're no longer behind in building out our AI infrastructure. And to the contrary, we now have the capacity to do leading work in this space at scale. As these new models and use cases continue scaling, we're going to need to continue investing in infrastructure, although we'll have a better idea of the trajectory of that investment later in the year once we can gauge usage of some of the new products that we'll launch. Beyond AI, the other major technology wave we're focused on is the metaverse. A narrative has developed that we're somehow moving away from focusing on the metaverse vision. So I just want to say upfront, that's not accurate. We have been focused on both AI and the metaverse for years now, and we will continue to focus on both. The two areas are also related. Breakthroughs in computer vision were what enable us to ship the first standalone VR device. Mixed reality is built on a stack of AI technologies for understanding the physical world and blending it with digital objects. Being able to procedurally generate worlds will be important for delivering compelling experiences at scale, and our vision for AR glasses involves an AI-centric operating system that we think will be the basis for the next generation of computing. Metaverse technologies will also help to deliver AIs as well. For example, embodying AI agents will take advantage of the deep investment we have made in avatars over the last several years. Building the metaverse is a long-term project, but the rationale for it remains the same and we remain committed to it. We continue to expect that Reels will become neutral to overall ad revenue by the end of this year or early next year. I always say this in all my videos, past performance does not guarantee future results. In the past, Meta's total revenue, earnings per share, and free cash flow often grew double digits almost every quarter. We should not use Meta's past financials and use the same growth rates going forward. Going forward, I think Meta will likely have single-digit revenue growth rates since Meta is much more mature and bigger than before. In terms of revenue forecast, Wall Street analysts forecasted that Meta's revenue will start growing again this year in 2023. Again, Meta's revenues used to have high double-digit growth rates before. Going forward, Meta's revenue growth rates are expected to be single digits between 7% and 10% each year. I think this is a reasonable growth rate for Meta going forward since Meta's ad business is much more mature than before. In terms of EPS forecast, Wall Street analysts forecasted that Meta's EPS should grow a lot in 2023 compared to 2022. This is because the overall advertising market is expected to recover in the second half of 2023. Also, Meta's advertising business is more resilient than what the market initially forecasted. Meta will likely lay off more employees going forward to reduce operating expenses, so this will likely improve Meta's operating margin and Meta's EPS at least over the next several quarters. Going forward, Meta's EPS is expected to grow at double-digit rates over the next 5 years. This suggests that Meta's operating margin will likely improve over the next 5 years since Meta is much more focused on cost efficiency than before, instead of overhiring employees again. Alphabet is Meta's biggest competitor in the online advertising market, so I want to show you some of their financials here to see which business is more undervalued and is likely better to invest in over the long run. This data is from Seeking Alpha. In terms of profitability, you can see Meta's EBIT margin or operating margin is slightly better than Alphabet's here. But if you look at other profitability financials here, you can see Alphabet's levered free cash flow margin, return on equity, return on assets, return on total capital, and even cash from operations are all better than Meta, even though they both compete in the same industry. In terms of valuation, you can see Alphabet's forward PE is slightly lower than Meta's forward PE. This data is from stockanalysis.com. You can see Alphabet's free cash flow yield is higher than Meta's free cash flow yield. This suggests Alphabet is likely more undervalued compared to Meta. Overall, I believe these financial metrics show that Alphabet's business model is more profitable than Meta's business model. Also, at the time of making this video, I believe Alphabet is likely more undervalued than Meta based on the forward PE ratio and the free cash flow yield. I want to show you how to calculate Meta's stock intrinsic value here so you will know when Meta stock becomes undervalued, fairly valued, or overvalued. If you want this calculator, you can download it from my Patreon blog. The link is in the video description. These are the key assumptions in this calculator. First, I define Meta's intrinsic value as its future free cash flow discounted to the present day. I use the discount rate of 11% here. You can use a higher discount rate here if you want to be more conservative. I expect Meta's free cash flow margin will improve gradually over the next 5 years because Meta is much more focused on cost efficiency now. Over the next 5 years, I believe Meta's revenue will grow at a compound annual growth rate CAGR between 7% and 10% each year. I think this revenue growth rate is reasonable. It's also consistent with the Wall Street analysts' consensus revenue forecast I showed you earlier. Let's go over these 3 case scenarios here: worst case, normal case, and best case scenarios. Under the worst case scenario, we are forecasting Meta's revenue will grow at a CAGR of 7% over the next 5 years. If we forecast Meta's free cash flow over the next 5 years and discount the free cash flow to the present day, Meta's intrinsic value should be around $546 billion for the entire company, or $210 per share. I'm giving this scenario a 25% probability here. Under the normal case scenario, we're forecasting Meta's revenue will grow at a CAGR of 8.5% over the next 5 years. Then Meta's intrinsic value should be around $582 billion for the entire company, or $224 per share. I'm giving this scenario a 50% probability here. Under the best case scenario, we're forecasting Meta's revenue will grow at a CAGR of 10% over the next 5 years. Then Meta's intrinsic value should be around $620 billion for the entire company, or $239 per share. I'm giving this scenario a 25% probability here. If we add all these numbers here, Meta's intrinsic value should be around $224 per share. Just to compare, Morningstar estimated Meta's intrinsic value to be much higher at $278 per share. My intrinsic value estimate is much more conservative than Morningstar's estimate. I believe Meta is slightly overvalued at the time of making this video. So will I buy Meta stock? Yes, I will likely buy back my Meta shares going forward if the stock drops well below my intrinsic value again. I made a huge mistake selling my Meta shares near the bottom because I thought Meta was becoming a value trap. I thought Mark Zuckerberg mismanaged Meta because he changed Facebook's main focus from social media to the metaverse. In hindsight, I was wrong about Meta. Now, Meta's app business is likely turning around. The advertising market is expected to recover in the upcoming months, which will benefit both Meta and Alphabet. More importantly, Meta has a very large economic moat known as network effects. It's very hard to replace Facebook, Instagram, Messenger, and WhatsApp. Meta has over 3 billion family daily users. Meta knows what each user likes or dislikes and has a lot of first-party data on each user. In my opinion, I think it's almost impossible for other competitors to copy Meta's network effects and social media apps. After selling my Meta shares, I reinvested the money in Alphabet because I believe Alphabet's search-based business model is much better than Meta's business model, which relies on a lot of personal data. I believe Alphabet is much more undervalued than Meta. I also reinvested the money in Microsoft when it was substantially undervalued before, so this is one of my best investments in this portfolio here. I also have other portfolios that have almost the same stocks and the same investing strategy. They are doing very well even in this market. Now, all these are only my opinions and my analysis based on my research. They are not financial advice. There are always risks associated with investing. You will need to do your own research and do your extra due diligence first before investing in anything. Thank you for watching this video and supporting our channel. This is Victor from the Intelligent Research channel, and I will see you in the next video.